My name is Marcy Bergen. I'm the Member Services Coordinator here at AFSA. Welcome to Auto Loan Accommodations, Insights from the Past, Applications from the Present, presented by Richard Francisco, Vice President, Automotive TransUnion. This presentation is a part of AFSA's Business Partner Webinar Series, which allows industry experts to share timely educational topics directly with AFSA members. The webinars are designed to provide information that allow AFSA members to more effectively design, develop, and implement strategies for their company's success. For more information about the series or how to become a presenter, feel free to reach out to me following today's webinar. A few housekeeping notes. To ask a question, use the question box on the side of your screen. I'll read them aloud all to following the presentation. The slides and recording of today's webinar will be available later today on AFSA's website in the Webinar Resource Center. Finally, you'll receive a survey after the webinar is over. Please take a moment to complete it. Your responses help us fine-tune the program so we can target the issues that are important to you. A bit about our presenter. Rich Francisco joined TransUnion in 2009 and is currently Vice President for Market Development for the Automotive Group. In this capacity, he leads TransUnion's efforts to drive adoption of TransUnion solutions in auto finance. He also has held roles in market development for TransUnion's mortgage, capital markets, and integrated solution groups. Prior to joining TransUnion, Rich held positions at HSBC Auto Finance, where he was responsible for direct-to-consumer marketing and then led operations and product strategy for consumer finance branch-based auto lending. Rich holds a bachelor's degree from the University of Michigan and an MBA from Washington University Olin School of Business. Now I'll turn it over to you, Rich.
Thanks, Marcy. Could I just get a quick confirmation that you can hear me?
Yep, you're good.
Okay, great. Good afternoon, everyone on the call. I'd like to thank you for joining us today, and also to thank Marcy and AFSA for giving us all the opportunity to get together for these important webinars. As Marcy mentioned, my name is Rich Francisco, and I'm a member of the automotive team at TransUnion. And today I'll be sharing insights with you on auto loan accommodations and what we can learn about loan performance from the past and how these insights can be applied to the present crisis. TransUnion has been closely following the reporting of loan accommodations across the spectrum of consumer lending in mortgage, credit card, fintech lending, traditional unsecured lending, and in auto finance. You may have seen some of our reporting in the public space. It's available also on our business website. But we'll focus today only on auto lending. And I'd first like to acknowledge the work of my analytics colleagues at TransUnion who conducted this study and who continue to follow the trends of loan accommodations, and also including Drew Kowalski, who is also part of the TU Auto team, and who's on the call with me to help address any questions. And Drew provided very significant thought leadership behind this study. So this certainly is a crazy world we're in. Normally, we might be seeing each other at different conferences, and like this webinar today, we're obviously virtual, and we have been for about the last 9 months. And suffice it to say, there's really no similar time in modern history to compare to this global pandemic and to its impact on consumers. As I've talked to many auto lenders in recent months, I've heard a similar refrain that we reacted quickly and survived April. Operations have stabilized, but we're very concerned about what's going to happen next. And one of the lender reactions, starting in April and continuing to today, is a broad program of loan deferments. You may have also read in the auto trade press similar questions about what do all these deferrals and accommodations mean for the auto lending industry. So TransUnion decided to follow the reporting and patterns of all accommodations and to dive deeper into the effects on portfolios. For auto, the sheer volume of loan accommodations really has no precedent, and it introduces a lot of uncertainty and unique challenges for auto lenders. So with this study, we sought to answer a few questions. First, how are consumers using accommodations during the pandemic? Are there any trends that we can spot Do we know anything about consumers who are receiving accommodations and how they're performing? Second, what did we see historically? There are certainly higher levels of delinquencies across all risk tiers, and in particular from consumers with certain characteristics. And third, what from our learnings can be insightful? Can past market behavior in aggregate give us a window into what may happen? And that's exactly what our study entails and what we'll be going through with you today. And finally, how can lenders use these insights? So it's great to provide insights, but can they be used in a practical sense in auto lending? Sorry, let me see if I can change the slide. Okay, so first I'll get into laying the groundwork about the current state of auto loan accommodations during the pandemic. But before jumping in, I want to define what an accommodation is for you. And there are different ways that data furnishers, auto lenders in our case, can report an accommodation on the credit file. And what I show here are the four codes that we used for our analysis. There's a forbearance remark code, which you might know as a CP or FOR, a natural disaster remark code, a deferment, which is simply a D on the credit report, and finally, no minimum payment due, which equates to a zero minimum payment due and a balance with a balance greater than zero. And these codes are used as well for the other loan types that I mentioned, mortgage, credit card, et cetera. So they're really pretty common across different loan types, but it really is up to lenders on how they report based on the accommodation program and really on the loan type as well. In an auto, we've seen the large majority reported as natural disaster. In fact, about 80% of all accommodations that have been done by auto lenders have been reported as natural disaster. So next, what I'm showing here is after the CARES Act passed in late March, we saw the number of auto loan accommodations surge. And I'm sure we're showing auto loan accommodations by month. And as you might have expected, there was a very big jump in April. Not surprising, as the pandemic and associated impacts took hold in mid to late March of this year. And we peaked in June of this year with over 7 million auto counts in accommodation in that particular month. And again, accommodations include those I noted before, so forbearance, natural disaster, deferment, and no payment due with a balance greater than zero. While the number peaked in June, there are still several million auto loans in accommodation. And this chart shows a bit more detail on how the numbers have changed. And so we provide a bit of a waterfall view here of accommodations that were granted in a month, removing any any loans that came off accommodation, resulting in the total at the end of that month. And again, we hit an inflection point through July when there were more removals than adds of auto accommodations. And the good news is that the number has come down. Though at the end of October, we still found about 3.6 million auto counts still in accommodation. And the total over the last 9 months was about nearly 13 million accommodations granted by auto lenders. And so with all these accommodations being granted, a question you might ask yourself is, well what's happened when a loan comes out of accommodation? What generally have lenders been doing? And what TransUnion has heard, and what we've read in various trade publications as well, is that lenders will do one of a couple things. One, they'll expect the consumer to catch up on the deferred payments as it comes out of accommodation, or they'll provide some other workout and grant some other workout to move the payments. And that's generally what we've seen as well. Okay. So we've covered the current state of accommodations during the pandemic. And now lenders and industry experts are voicing increasing concern about a possible wave of defaults. And so we'll look into some historical observations about what accommodations have meant within the auto space. And to do so, we started by building a study sample to see if we can learn anything about the performance of auto loan accommodations from the past. And so this slide shows the waterfall of how we've built this study. We looked at auto trades from the beginning of 2014 to the end of 2017. That's the starting number at the left-hand side of the chart here. That's 142 million auto trades. And of the total, nearly 140 million didn't have an accommodation of any kind. Okay, so we removed that from our study sample. We then took out natural disasters, for example, hurricanes, as the leading impact on borrowers for those was likely due to collateral damage. So we removed those. Then we also took out any loans with an early payment holiday indicator, which is likely a promotional offer. So that removes consumers on accommodation within 3 months of the loan opening. And we were left with a sample of about 300,000 loans to study from 2014 to 2017 that had some sort of auto loan accommodation. Oh, I'm sorry, folks. Okay. We then looked at 48 vintages, so that's quarterly over the 4 years of our study, and first compared those with an auto loan accommodation to those without an auto loan accommodation to see if there's any difference in performance between those borrowers. All right, so this chart shows the example of each vintage with time T of the new auto trade, and we measure as of T plus 36 to a charge-off status within our study. Our study group is those consumers who went into accommodation during the performance period. And the control group is consumers who did not go into hardship over the same time period, okay? And as expected, consumers who enter an auto accommodation on average are significantly more likely to charge off versus those who don't enter an accommodation. And in this chart here, we show the study and control group by standard Vantage Score 3.0 risk ranges at origination, right? From super prime down to subprime. So for example, if you look at the super prime comparison, only 0.2% of the non-accommodation group ended up charging off at the end of our study, while 4.4% of our study accommodation group charged off, right? And that then holds as you go through prime plus, prime, near prime, and subprime. And in total, the non-accommodation charge-off rate was 4.4% and 8.7% for the accommodation. And the relative negative impact of entering an accommodation is greatest among super prime consumers. In fact, 22 times more likely to charge off. And as you see, the impact kind of tapers off through near prime, where it's 2 times more likely to charge off. And then the trend actually reverses itself among subprime. So if you see on the chart, a higher charge-off rate of non-accommodation versus accommodation. So it's worthwhile to note in the subprime bucket, because subprime consumers are sometimes described as being in maybe perpetual recession. It actually makes sense that an accommodation provides a needed temporary relief for a troubled borrower and perhaps moderately reduces their likelihood of charging off during the 36-month observation period of our study. Now, if you extend that observation window to 48 months, we actually see that the subprime non-accommodation and accommodation performance nearly converge. Okay, so just wanted to make it clear on sort of this outlier in the study, which may have caught your eye. Okay, so once we confirmed a difference in performance among accommodation consumers, we decided to look for more insights. So after creating our historical accommodation group, we wanted to ask ourselves some additional questions. What are the strongest signals of performance that we can easily find? How can updated risk scores help with understanding accommodation consumers? And are there any additional signals we can find to gain further insight on performance? And that is essentially then the next step of our study. So we then decided to explore consumer credit and payment characteristics observed both before and during the accommodation period. Okay, so on this part of the study, the time chart here shows time S on the bar chart as when the consumer enters accommodation. And at that time, we measured several metrics. One, any auto trade information that we can see. So any auto trade characteristics such as loan amount, payment, et cetera. Vantage score 3.0, which represents widely one of the common risk tools that many use. And we also measured TransUnion's credit vision trended and other traditional credit report attributes. And then we measured the charge-off status for these borrowers in accommodation. So that, at time S plus 18 months, what was the charge-off status? And I'm going to share now with you a little bit of what we learned. Okay, so the first characteristic that we looked at was payment history. And again, we're looking at two comparison groups here across the standard Vantage score risk ranges. Those consumers with no prior late payments and those with at least one payment of 30 plus days past due before the accommodation. And not surprisingly, consumers who were previously late at some point on the auto loan in question performed worse than those who were never late. And that's true across all segments, as you can see, from subprime all the way through to super prime. Again, and the chart is consumers in our study who had no prior late payments, and the green bar is those who had at least one 30 plus late payment before the accommodation. Okay, so it's true across all segments, but what does that exactly mean? Well, it shows us that there's a significantly higher charge-off rate for those consumers. However, what we see in our study is that most consumers actually did not have that late payment, especially when you start looking at prime and above. It's a very, very small percentage of the overall consumers. And in our study population, in the total line, we saw that only 10% had one late payment or more before the accommodation. So while it's insightful, it only impacts a very small segment of the population. Okay, so what did we do next? So we revised the study population to remove those who had a prior auto delinquency. Though the impact on the population was minimal, we're still left with the majority of our study sample. And you can see on the right-hand side highlight of this chart, it removed about 100,000 or less than 100,000 from our sample, and we're still left with the majority of our study sample population. Okay, so then we wanted to look at the next signal, which we could potentially use to learn more about these consumers. And so we looked at risk score at the time of accommodation. And we asked ourselves, could it tell us something more about the risk level of these consumers? So we profiled the accommodation population to compare risk range distribution at origination versus when the borrower went into accommodation. Okay, so there's two risk scores then. Again, one at the risk score or the Vantage score at origination, and what's the Vantage score at time of accommodation. And so, for example, 25% of our study population scored as subprime at origination, as you can see on the left-hand side of the chart, but 32% scored as subprime at time of accommodation, meaning some consumers' scores declined as they approached that accommodation period for some reason. Right? We didn't segment out what those reasons were. And while the risk score did provide some updated information about consumers and better risk prediction, as you move up the ranges to prime plus and subprime, there wasn't much separation. So you can see here in prime plus, there's 14% were scored as prime plus and 13% at time of accommodation, and super prime, it's 10 and 10. So again, there's some lift from an updated credit score, but due to that limited lift we see from just an updated risk score, we set out to discover, are there any additional signals that we can look at to better segment and identify risk? So essentially, could there be more to the story? Okay, so what did we do next? We identified additional auto trade and credit characteristics that could help segment risk even further. And while we looked at many characteristics, in the interest of time, I'm just going to dive deeper into a couple of them to show how they provided additional insight into the accommodation population. And specifically, I'll look at one auto trade characteristic, so loan and lease term, and one additional traditional trended credit characteristic, and that's the number of non-auto or other loan late payments. Okay, so first let's look at the term and whether that could tell us anything interesting. And looking at the term of the loan or lease, we found consumers with a term of 25 to 48 months here in the boxed part of the graph had higher charge-off rate. Right, so this chart separates our study population into the loan or lease term from 24 months up to 72 plus months. It also separates it into percent of population within each term bucket, and also we, just for comparison purposes, we put average monthly payment. And while there's some differentiation among performance, the lift is limited, right, as you can see from this chart. There's also some consideration of loans versus lease and new versus new loans. And really this is driven primarily by leases having a higher charge-off rate than loans in the study, and used loans having a higher charge-off rate than new loans. And as we can see, used are a higher share of these 25 to 48 month term loans. So overall, just looking at loan and lease term has some, but limited additional insight. Okay, so what's the next characteristic we look at? And so next we looked at consumers who had a late payment on non-auto trades. So again, that's any other trade on the consumer credit file that we can see, be it credit card or mortgage or an unsecured loan. And we found that those with a late payment on a non-auto trade were significantly more likely to charge off on the auto loan. And in fact, 44% of our study population identified with more risk. And we saw similar lift among similar credit attributes such as total past due amount on that non-auto trade. So lenders can better assess risk by looking at credit attributes beyond just the auto trade on their own book. And certainly one way to do this is through a portfolio review to look at the consumer credit profile and understand how that consumer is performing on the non-auto trades, right? So this credit report characteristic seems to provide much more insight than, say, loan term that we showed on the prior slide. Okay. Now, with these findings, the TU Analytics team then decided to see if we could develop a proof of concept model to determine if using these attributes that we looked at can better predict risk. So we built and validated a proof of concept model specifically for auto loan accommodations. And we're using our same study population from 2014 to 2017 with a target modeled outcome being charge-off, right? And so our goal was to understand if there's any incremental lift in segmenting risk by including these additional attributes to complement traditional risk models, such as VantageScore, right? So that's the next step of our study was, could we take any of these insights and actually model it and build a model that we could apply to the current state? Okay, so as it turns out, when you use more than one of these attributes, you're able to get incremental lift in risk splitting. And this is a pretty busy chart. And if you haven't seen a lift chart before, I'll try to describe in pretty basic terms what you're seeing here. So if you look along the x-axis, what we show are are the cumulative percent of auto trades in our study group, okay? And along the y-axis is the cumulative percent of charge-off that are captured by various models, okay? Then we apply our proof of concept accommodation model versus VantageScore 3.0 at entering origination, right? And what you see by the various lines helps to show you the results of capturing charge-offs by applying that certain model. The first is the dotted green line, which is a random selection, which means it's not modeled. And as you can see, it's just a straight line. The second red line is applying credit score at origination. And I'm sorry, the light green line. And as you can see, it separates risk versus just a random line. Third is credit score at origination, which is the darker green line, which again provides additional separation. And finally, our proof of concept model, which is the blue line, which uses credit score and our other credit and trended attributes, which shows pretty significant lift in measuring risk in this population. So as an example, if you compare our proof of concept model, it shows a 24% improvement over just score at origination. So 30% of charge-offs are captured in the top 20% of auto trades just by using credit score at origination. But if you apply the model, it captures 54% of charge-offs in the top 20%. And that's essentially what we show here by using a lift chart. And the reason for this big lift for our POC model are a few things. One, it's the application of trended credit attributes. Second, the special attributes we talked about. For example, loan term, which is not really in standard credit scoring model. And third is this is a specially trained model, right? So we built this model with the accommodation population, and we're applying it on such a population, right? So those are the reasons for this really significant lift in risk separation by applying this proof of concept model. Okay, so to this point, let me recap where we're at before we go into the next section, which is can we use this to apply any of the learnings to our current crisis. So using standard and credit attributes, we can better separate high risk auto accommodations, and data available to lenders in-house can help segment risk within auto loans and leases. However, standard credit and trended credit attributes enable even more segmentation of risk. And a model purpose-built for something like auto accommodations off of all three sets of attributes can provide significant lift beyond just the updated credit score. Okay, so now let's think about implications for go-forward strategies. And now we understand the state of accommodations during the pandemic. We've seen that we did find insights from past accommodations, and we can in fact model the effects. But really, what does this imply for go-forward strategies? Okay, so let's take a look at applying these learnings to the current crisis, and there's actually some very interesting findings. First, we grouped consumers the historical auto accommodations charge-off rate based on our proof of concept model deciles, right? So that essentially takes the accommodation group and creates 10 buckets or the deciles from low to high risk. So low risk identified about 32% of the population, medium risk was about 41% of the population, and high risk, so those with the highest risk of charge-off, was about 28% of the population. And this shows that our proof of concept model risk rank orders very well, right? Showing that high risk consumers had about an 11-point higher charge-off rate versus the low risk consumers. Okay, so next, as we showed before, 28% of our population modeled as high risk. And as you could expect, modeled high risk is more prevalent in all risk tiers. So prime and above in the standard VantageScore risk tiers have a lower share overall of high risk consumers, with near prime and subprime having a much higher share of higher risk consumers. So again, that's high risk as defined by our proof of concept model. However, there's still a meaningful share of high and medium risk consumers within prime, prime plus, and super prime. So if you look at the prime bucket, 13% of consumers within that segment were modeled as high risk, and 6 and 3% respectively in prime plus and super prime. Again, and overall about 29% or 28% modeled as high risk. So lenders across the spectrum should be monitoring their portfolios for high and medium risk consumers, whether a lender is a subprime lender or a full spectrum lender or a more prime and prime plus focused lender. Okay, so we've looked at the historical accommodation population. We looked at insights among that population group, and we found we were able to model it. Now let's tie this back to the current COVID-19 accommodation population, which I told you about at the beginning. That's the 13 million overall that entered accommodation at some point, and the 3.6 million that are currently in accommodation. Okay, and the risk mix in today's accommodation population compared to historical is much more favorable. Okay, and this is shown on the chart on the left-hand side of the slide, and you can see that there's a 12% smaller high-risk share between today versus historical, with nearly half modeled as low risk, as compared to 30% modeled as low in our historical population, which is really good news for lenders. Okay, so maybe the populations are a little bit different, and we believe this might be the case because many prime consumers likely took accommodations that lenders offered perhaps as a backstop, right, during the crisis, but still paid as agreed. However, as shown in the chart on the right-hand side of the slide, the sheer numbers of accommodations and high-risk consumers is much larger now. In fact, 20 times higher number of overall high-risk consumers. And all of these entered accommodation in 2020 and likely all based on the COVID crisis. So the point here is lots of people are in accommodation within portfolios, and knowing a bit more about those consumers beyond what a traditional risk score can tell you will help shine a light on possible blind spots in portfolio management, right? So with these insights in mind, what then is the call to action? What can you actually do with this? And I thought of 3 moments with your customers where this can be helpful. First is prior to entering accommodation, which obviously most have already happened, although as you saw from our chart earlier in this presentation, there still are consumers entering accommodation even now, as some lenders continue to offer accommodation programs. And so potentially lenders can prioritize accommodations by known loan characteristics that we highlighted and provide accommodations to those who need it most. The second time period is while in accommodation. And lenders can certainly identify high risk by using attributes such as non-auto late payments or prioritizing outreach based on highest risk. And highest risk either as defined by something on the order of a proof of concept model that we highlighted, or by other credit and loan characteristics. And certainly a lender can update loss forecasting with a custom risk model and understand based on all those consumers in accommodation and given the insights that we know they will perform differently than all other consumers, how will that affect overall loss forecast? And finally, for exiting accommodation, lenders can certainly use some of the attributes and risk scores we noted to make a decision on what to do next. Do you expect the consumer to remain current by catching up on payments? Do you need to extend the accommodation or enter some kind of workout? Certainly there are more strategies than just what I put on this slide, but within these 3 time periods of prior, during, and exiting accommodation are certainly times that these sorts of strategies can be applied. And let me see here if I can get to the next slide. Sorry, everyone. Okay, so there was a lot in this study, and I certainly will pause here in a minute to summarize before opening for any Q&A. But let me go through just real briefly a summary of what we covered in this session, because again, there was a lot. We went through information on the current COVID accommodation population. We then took a look at what we could learn from historical population of accommodations. We modeled what we could find based on that population, and then we determined, okay, what could we apply to the current state? And we learned that lots of consumers are in an auto accommodation, right, across all risk tiers. And those who enter an accommodation generally perform worse than consumers who never took an accommodation. And so they present an elevated risk to lenders. Second, our historical analysis showed that loan characteristics such as term and payment and other consumer credit attributes, particularly trended attributes, can be particularly helpful in segmenting risk within an accommodation population. Third, by complementing a traditional risk score with a multi-attribute model that leverages these loan characteristics and basic credit attributes, we can better identify risk of accommodation population in a portfolio. And lenders can use these types of insights to better manage that portfolio, or better manage their portfolio, and also to help their consumers. And finally, even finding incremental increase in lift in a very small part of a portfolio, whether it's a subprime or a super prime portfolio, can help direct strategies for portfolio management. Okay, that reaches the conclusion of the study and summary. And Marcy, I'd like to ask you to see if we have any questions from the audience, and we have some time remaining, and I'd like to address any of those questions. But again, thank you everyone on the call for the time today, for your attention. And if you have any questions, please bring them forward now.
Thank you, Rich. We have a few questions. The first one is, some reports indicate that many borrowers on accommodation are still making payments. So it seems like this time is different, with borrowers taking advantage of a free option versus truly being in distress.
Yeah, that's a good question. Thank you. Yeah, we agree that this is happening to some degree. The issue isn't really one of mix. We showed in our presentation that we could see high-risk borrowers on accommodation were historically, I think, about 30%, and now they've dropped to 18%, right? So there's a better mix overall today. However, the issue is the sheer number of borrowers on accommodation, and we believe the number of high-risk borrowers was pretty low in our 2017 study, about 50,000, and today it's over 1 million that we would model as high risk. So it truly is a different in terms of we believe more truly being in distress versus just taking a free option. I hope that answered that question. Yeah, sure.
Another question is, my book is prime and above, so it doesn't seem like I have much to worry about. Am I missing something?
Yeah, great question. And certainly our studies showed that there were, a lower percentage of high-risk consumers within, prime plus and super prime. And while that's true, prime plus still has 43% of borrowers in total, and 6% of those are considered high risk, and medium was 37%. So super prime is while a lower percentage overall, we think that no lender really is spared, right? There are high risk consumers in all portfolios, and it's I think a reason that whether you're a subprime lender, full spectrum, or prime lender, that it's worth looking at your portfolio to see what that mix of accommodation consumers looks like.
Great, thank you. Another question is, when should we expect to start seeing deterioration in performance among auto loans currently in accommodation?
Yeah, that is a really great question. We, as you would expect, there's, delinquencies take effect over a period of time. It's difficult to give a precise answer given all the uncertainties around our current economy, be it economic recovery or additional stimulus, or even additional accommodations that a lender may grant. However, if you look at the performance window for our study, it was 18 months from when the consumer entered accommodation to the measure of charge-off. And many auto consumers started entering accommodation during the April to July timeframe, right? So we would generally expect to see most of the changes in performance due to accommodations from now until probably the end of 2021. So it's not just a 2020 effect. We would expect to see, even after a consumer comes out of accommodation, for there to be a heightened risk of charge-off for someone who's higher risk.
Thank you, Rich. Another question is, if we don't have current credit data available at the time of accommodation, is there anything that can be gleaned other than whether they were previously delinquent? We are subprime if that matters.
So could you repeat the question, Marcy?
Yes. If we don't have current credit data available at the time of accommodation, is there anything that can be learned other than whether we are previously delinquent? We are subprime if it matters.
Yeah, I think the.
Oh, go ahead, Rich. I can always add in.
No, go ahead, Drew. Thank you.
Yeah, sure. So I guess there's a couple of things. So one thing is, you mentioned other than whether they were previously delinquent on that trade. I will just kind of call out on that one is there was a slide earlier before we got into some of the meat of the study that showed that was very highly predictive. If their payment challenged before they went into accommodation, they were likely going to be challenged coming out of accommodation. So that is something where for some of you to look at. But then in terms of other than that, there are a couple of things that we looked at. Some are just the characteristics of the loan itself. So I know one of the kind of transaction variables that we looked at that Rich highlighted today was the actual term of the loan. And we did look at some other transaction related variables that were relevant, for example, leases versus loans, and leases seem to perform slightly worse than loans. But then I think the other thing that I would call out is really when we built our POC model, the real kind of value was bringing together the traditional credit, the transaction data, plus the trended data and alternative data. And for the purposes of this study, we did take a snapshot at the time of entering accommodation just because of when we were conducting the study and trying to figure out how much information we can glean into the future. However, now sitting in December, we've got the advantage of some additional performance data and whatnot. And so even doing a portfolio review type process now on your book would be even more valuable than the types of insights and predictive power of our proof of concept model we were able to do, just kind of limiting ourselves to at the time that they enter accommodation. So you might not have taken a snapshot in time back when they entered accommodation, but that's okay. If you wanted to do a portfolio review on your book today and take a snapshot today, we would actually expect even better results, especially as we've started to see auto trade lines and non-auto trade lines coming out of that accommodation. We now have the benefit of some of the more recent payment history as well for some of the cross wallet fees too. So hopefully that answered your question.
Great, thank you, Andrew. Another question is, what are the best tools and data to develop a custom risk identifier for accommodation and origination to augment the credit score?
Yeah, that's a good question as well, and I can take that, and Rich, feel free to chime in here. What we've seen, so I think what we tried to highlight is the generic credit score itself, the common credit score. It does have a lot of lift still with it, but for this very narrow population of the accommodation, the credit score is meant to be used in many other use cases than just accommodation. So really focus on the accommodation population, what we saw providing the most lift was really some of the trended data attributes plus the cross wallet. So when you start thinking about consumers of, really their payment hardship, because this is a little bit of a unique, time period, especially in terms of the scale, but also the depth in terms of the consumer wallet that it really affected in terms of their mortgage payments, their credit card balances, et cetera. So the cross wallet view really provides quite a bit of lift and some of the trended data of how were they trending when they entered this accommodation period. Were they already, sliding down? What was the aggregate excess payment, just as an example? So aggregate excess payment for the folks, just to reiterate, is the amount that the consumer is paying beyond their minimum payment due. So, how did that trend over time? Were they really going above and beyond and paying more of their monthly payment, or was that trending down to just the minimum payment due? So looking at some of the trended data really did provide quite a bit of lift, and then just combining that together with the traditional credit data together, really helped narrow down and segregate some of this accommodation population here.
Yeah, thanks, Drew. And I brought up again the slide that showed what Drew referred to as cross wallet, and that's the late payments on non-auto trades, where we showed very, very significant increase in risk for those who had a late payment. So again, that kind of cross wallet view is really important.
Thank you. Looks like that was the last question. So thank you so much, Rich, Andrew, TransUnion, for sharing your expertise with us. Remember, the slides and recording will be available later today on AFSA's website in the Webinar Resource Center. Rich, if you want to make any concluding statements, feel free to.
Oh, no, again, I'd just like to Marcy, to thank you and to thank AFSA for this opportunity, and to thank everyone on the phone for joining us. We hope you all are navigating through this time as well as can be expected, and we certainly hope that some of the positive signs we're hearing and seeing get us all back out and seeing each other outside of our homes and back into our offices, and that things are more normal in 2021. So I hope everyone has a great end to your year. Hope you have happy holidays and happy New Year as well. Thank you.
Thank you.